My name is Justin Urquhart Stewart, and those who've been to this regularly, welcome back. And if you haven't, well, you're very welcome to be here. I'm just going to point out, or what I tried to do is point out a few useful items, I think, in the stock market that we miss occasionally. It's exciting enough with the markets going up and down, and it's going to be a lot of drama, I suspect, this autumn as we enter the season of storms. So I don't just mean meteorological ones as well. There are going to be some financial ones, inevitably. Obviously, we've got the major election coming up. And of course, after Labour Day, then things get starting to get, I think, a little bit more exciting in terms of actually where the economy goes next. The global economy is still growing, despite what's happened in the global pandemic. And so I'm slightly more positive, actually, as how things are going to go. But it's going to take some coordinated economic action. And that has to be led by the states. Now, one thing we shouldn't forget at moments like this is not just stock markets going up and down. That's the easy bit. Buy them when they're low. Don't they always tell you that? Actually, long-term investment is actually about that compounding of dividends. And this varies hugely. If you look at the S&P 500, for example, the highest level of dividend yield you have is back in the 1930s at nearly 14%. Quite remarkable. Actually, since then, it's dropped dramatically. The lowest level we saw was at 1.1% back in the year 2000. And now, well, it's about 1.82%. Last year's 1.88. It's not particularly exciting. But with interest rates at, what's the technical term, naught, it's better than nothing. So for those actually who are looking to actually build up longer term value, then actually dividends are important. Yes, they have crashed dramatically, both in the UK, elsewhere around the world, but also you've seen them in the US. It's hardly surprising because companies have been very weak. They will pick up from this and dividends will start picking up again. But at the moment, it is going to be low. So you're planning in terms of how your money is going to double. Remember the rule of 72? Divide into 72 the return you think you're going to be getting, that yield, and it'll tell you how often your money will double. So if you're getting 7%, then divide that in, your money is going to double in just over 10 years. Great. At 1.88%, not so exciting. It's going to take about 38 to 40 years for your money to double. But if you're doing long-term financial planning, then that's a useful number to know. So watch out for dividends. You'll very easily get caught up by companies paying apparently a high yield of dividend. Well, often that means they're just about to cut it. The share price has dropped and they probably can't afford the dividend. So don't be fooled by that. Look for the consistent payers, and even those necessarily will change. So who else would you have? Well, the banks were always consistent payers, but not so much anymore. The utilities, well, they should be, but again, they can be pretty variable. So you have to look at other areas where they're going to actually pick up a little bit more. Maybe the telecoms companies and communications ones, you'll know full well they're still going to be there. And of course, the energy companies, changing now from oil, no one talks about oil anymore. It's all going to be about renewables. Whatever your energy, you're still going to need it wherever it's going to be coming from. So the dividends will come back. Sadly, the area you won't get much of the way of dividends are the exciting tech stocks. Now, the smaller ones, we always try and buy and see our money double and treble. They're difficult to find. Unfortunately, what you'll find for every one you get, well, you get a winner, you'll probably have to have 5 or 6 losers in the meantime. So that's the exciting stuff, but high risk. For actually getting your dividends, it's lower risk, but it takes a longer term. So what you do, the answer is you'll split your money into different parts. Some is going to be long term and let that compounding effect occur. So you actually do get that sort of return. It does mean that actually you're protecting your value and growing it over time. Particularly at moments like that with very low interest rates and very low inflation as well. But watch it, if inflation starts picking up and then you find your dividends don't, then you'll find yourself in a nasty position then where we're losing money in real terms. So dividends, don't miss out on these sort of ones. Look carefully, choose the consistent pairs, because those are the ones that are often spoken to their institutional shareholders, and their institutional shareholders themselves want them to be regular pairs. Why? Because they're the ones that actually are looking to make sure that their pension schemes are operating properly. So they need consistent pairs coming through the whole time. So it will be financial institutions, but not the renegade banks. It'll be the more sustainable financial institutions. It will be the energy companies in due course. It will be the communications companies. Those are sort of ones where you've got to find greater levels of reliability on it. If you don't want to be able to pick the individual ones, then you can go and actually get an ETF, which will actually give you a yield on it as well. And one that will specialize in it, and that'll give you a broader spread.